Video, we examine the third part of the accounting cycle, the preparation of the financial statements. If you need additional practice with the content and the meaning behind the financial statements, I recommend you watch the video entitled Review of the Financial Statements on my YouTube channel. The accounting statements are interrelated because of these two relationships. For each year, we present a balance sheet, which looks at the transaction at a given point in time, and it's followed up by the end of period balance sheet. When you look at a company's corporate statements, you'll see the beginning of the year and the end of the year positions. They're joined by these flow statements, the statement of cash flows, the statement of stockholders' equity, and the income statement, which show the results of operations, how monies flow through the business over a given period of time. The results of the income statement feed into the balance sheet as retained earnings. The statement of stockholders' equity feeds into the balance sheet, again, as retained earnings and changes in the owner's investment account. And the statement of cash flows shows where the money is coming in and how the money is going out. Let's take a look at these statements in more detail. Now we'll resume our accounting example with good old Saul Goodman from Saul Goodman Attorneys at Law, LLC. If you need additional review of the financial statements, I recommend you watch the video entitled Review of the Financial Statements. Otherwise, jump on in here. Here we've got Saul's chart of accounts. The chart of accounts shows a breakdown of the different ledgers and that feed into the journals related to each of the primary categories of transactions presented in the financial statements. They almost always follow the same schema, with assets in the first grouping of accounts, liabilities in the second grouping of accounts, equity in the third grouping of accounts, and then in the fourth, fifth, and sixth grouping of accounts, the revenue accounts, the expense accounts, and finally the dividend accounts that feed into the income statement and the statement of owner's equity, respectively. Here we see Saul's trial balance, which records his initial transactions from starting up his business and conducting his business, the adjusting entries that we made at the end of the period to make his financial statements reflect reality, and finally the adjusted trial balance, which shows the total amount of all transactions after having made those adjustments. We can also see that the adjusted trial balance shows the same pattern and schema as our trial balance do. Our asset accounts are recorded, followed by our liability accounts, followed by our owner's equity accounts, and finishing it all off is our revenue and expense accounts, which hit our income statement. We can also see that our debits and our credits equal. So we've recorded a debit and a credit appropriately for each of these transactions. The first step in preparing our financial statements is to prepare the income statements. This is because the operating profit from all of the operations during the month eventually hits our balance sheet via the statement of retained earnings or the statement of changes in owner's equity. We start with our revenues for the month, which for Saul includes revenues only from his legal operations. We subtract any cost of goods sold in providing those legal services, which gives us our gross profits. Then we subtract each of the categories of expenses that we incurred during the month. We see Saul had consulting expenses, insurance expense, depreciation expense, salary expense, rent expense, and utilities expense. As he gets into a pattern of business and can better understand his operations, he might also accrue for income taxes, and he might also add other categories of expense that better reflect his operations. The difference between the gross profit and these operating expenses, or selling, general, and administrative expenses, is his operating profit. Since Saul is not at this juncture recording income tax, and he's not reporting any interest from having borrowed money, this is our net income. But there are other categories of profit and income as well. This $1,800 number feeds into our statement of changes in owner's equity. The second phase in preparing the financial statements is computing Saul's retained earnings, which you reconcile using the statement of changes in owner's equity or the statement of retained earnings. Saul Goodman's business is in its first month of operations, so he's not bringing any previous profits into the current statement. His beginning balance of retained earnings is 0. He increases his retained earnings with the net income received from his first month of operation, and that's pretty exciting that he gained a profit in his first month of operations, because brand new businesses typically don't render a profit in their first month of operations. Saul didn't pay himself any dividends this month, but if he had, they would be deducted there. So again, we start with the income statement, and the net effect of those transactions is the operating profit. This becomes our net income on the statement of retained earnings, which when we close the books, will get updated to its proper balance. The third phase of preparing the financial statements is the preparation of the balance sheet. The balance sheet shows the accounting equation. It presents our assets as well as our liabilities and our equity. In order for our statements to balance, we must report the retained earnings at our updated balance, because we want our balance sheet at the end of the reporting period to reflect the impact of our operations throughout the preceding period. And here you can see how each of the numbers translates from the adjusted trial balance back to the balance sheet. Cash of $14,900 is reported as a current asset. Accounts receivable of $1,000 is reported as a current asset. Supplies of $100 are reported as a current asset. The balance of our prepaid insurance is reported as a current asset, and we can sum our current assets and arrive at $17,100. Our non-current assets include our property, plant, and equipment net of depreciation, which we computed in a previous video. Right now, Saul doesn't have any accounts payable or salaries payable. He paid himself up front, but he does have a liability for the utilities he owes for using his workspace. He also has a liability for the unearned revenue from Jesse Pinkman. Remember, we had made that adjustment in a future transaction when Saul did the work. This leaves us with total liabilities of $10,100, contributed capital of $10,000, which comes from the adjusted trial balance, and the retained earnings, again, which we computed in the previous step, of $1,700. We see that our total assets equal our total liabilities and equity. One of the places you might get hung up as you prepare the balance sheet is with the contra accounts. This is why we prepare the income statement first, the statement of equity or retained earnings second, so that we can report the net impact of our operations at the end of the period balance sheets. The other place where people might get hung up is with the other contra account presented on the balance sheet, accumulated depreciation. If your debits and credits don't tie on your balance sheet, check to make sure that you're subtracting your accumulated depreciation, not adding it. The final statement that we would prepare is the statement of cash flows. Although we won't run through this process in this video, it's important to note that there are two primary ways of computing the statement of cash. The first is via the direct approach. This is more practical for small businesses like Sol's, where you're only making a few cash transactions each period. In the direct approach, we sum the activity received from the operating activities and spent on each of the categories of investing and financing to get a total from each of the three categories. And below each of the three categories, you see examples of the expenditures that Sol made during the preceding periods. When you add them all up, you should arrive at your ending cash balance. The approach that's much more popular with businesses that have a larger volume and deal frequently with cash transactions is the indirect approach. This begins with net income and makes adjustments for the non-cash transactions that don't hit your net income, things like equity and the purchase of equipment. And it adds cash transactions that do impact net income. After you prepared the 4 financial statements, you'll close out your books. And you'll do this by entering journal entries for the temporary accounts. The way you know it's a temporary account is whether it's an income statement account. And we'll close these to the retained earnings so that our books reflect what we report in the balance sheet. But that's a story for another day. Happy trails, be brilliant.